The sad story is that folks are saying now that I've worked my entire life and here I am planning to retire, only to lose it all. Now, this actually was a paraphrase quote from a story that I came across of a woman, a Florida resident named Michelle. And no, not my wife, Squirrel Tribe. This was a different Michelle. She was in the Orlando area and she was telling a story of how she received a letter in the mail from her student loan servicing company or lender. And after 20 years of paying off student loan debt that she thought she was free and clear of, she received a letter in the mail that said she had a outstanding balance that was severely past due. A I don't even understand. I don't even know if I could really put myself in her shoes as to the feeling that she had when she opened this letter after 20 years of a debt that she thought she had paid off completely, only to realize that now, with late fees and added charges and interest, she owed them almost $1 million. Now, long story short, this was a mistake. This was a glitch in the system. She did not owe them $1 million, and the bill was $955,000 and change. But fortunately, through some helpful folks, some friends, and some folks on Reddit, she was able to get a resolution relatively quickly to the matter. However, it still it still connects with what I think a lot of folks are experiencing and feeling and worrying about and preparing for today, which is it's the sad truth that more than likely retirement isn't in the cards. Now, there are a lot of varying factors that will play into why retirement just may not happen for many. But let's focus on what we know. What we know is that inflation is extremely high. Now, it's like, well, okay, well, inflation can come down. So it can't necessarily be a ongoing problem forever. Maybe not. But inflation today can have a huge impact on folks and their retirement and income or retirement savings. If they were looking to retire, perhaps maybe in the next 6 months, 1 year, 2 years, which honestly, with the way that some of the things have been going here lately and our nearing retirement, I would probably be looking to retire early just to get my distance myself away from the craziness and nonsense that's going on. Your employment. Your employment can have a huge impact on your ability to retire, especially if you lose that employment that was going to offer you those retirement benefits. We have the Social Security system, which is a rapidly depleting fund that will probably not survive the test of time for folks who have been actively working and paying towards and into it, only to realize that the funds won't be there for them when they need them. We have security threats of folks out there trying to take away and steal wealth from folks through situations like FTX with Sam Bankman-Fried, other cryptocurrency wallets out there that have left folks high and dry and basically have wiped them out and frozen their funds. And, you know, we have to be cognizant, mindful, and diligent in what we are planning to do tomorrow, because we have to do those things today to make sure that they're ready. And a huge part of that is the safety and security. It'll be impossible to consider retirement if your retirement portfolio, your retirement savings, and your retirement investments aren't safe and secure. Because you could retire tomorrow and have a $3 million nest egg. And if you make the wrong move, that $3 million nest egg could be wiped out completely. And that will have a huge impact on your retirement or lack thereof. And perhaps maybe considering, well, I'll go back to work. Well, that may not be as easy as you think, nor as easy as it was in the past, with thousands upon thousands upon thousands of people losing their jobs and receiving notification and headlines. Worst part about it is some of these folks work for these companies, and they have the news broken to them that they're going to lose their job through a article headline or Twitter tweet. Even worse than that is some of these folks are losing their job and they're getting separated, terminated, let go, fired, laid off through a text message. That was actually a story of the furniture company. It's a pretty large furniture company. They laid off 2,700 employees days before Thanksgiving, and they did it through a text message. Crazy. So these are things we need to be aware of and working towards to make sure that we don't end up in a situation where we are painted into a corner, backs against the wall, and you have nowhere to go because you weren't planning for all the possible, pretty much all the possible counters out there that are weighing against and pushing against you and your ultimate goal. So, I think the employment portion of it is a huge concern right now, because obviously with the way that the economy is and that the way that inflation is and the way that global conflicts are and probably will forever be, the Fed is continuously making a push to curb inflation. But in all actuality, this curbing of inflation just puts people's jobs and incomes and livelihoods at risk. So I got to be thinking to myself, maybe you too, but I've got to be thinking to myself, how can I secure my income? Why? Because my income is at risk. If I work for a great company, and I've worked for a great company for a long time, I'm a great employee, but the company falls on hard times through no fault of their own, just perhaps maybe as a result of the effects of the economy, because we're all intertwined, we're all locked in together. Perhaps maybe a railroad strike could really financially cripple my company that I work for, with no ability to receive the railroad freight that we need. Perhaps diesel prices go so high that it eats into company profitability, which they have to make cutbacks and reductions. There's perhaps maybe you work for an automotive dealership, which they are on the decline through announcements and shared updates that there will be a lot of car dealerships that go out of business and close down for good because of the requirements and the demands by the manufacturers to support the new EV lineups, which is obviously being pushed heavily by legislation and the current administration for this green renewable energy kick. But at the end of the day, the dealerships are saying, do I really want to invest all this money into EV vehicles to sell at a time when we can't get vehicles to sell, which could lead to EVs being sold direct to consumer from the manufacturers, similar to the Tesla model, But these changes in the economy, which affect businesses, can ultimately affect your employment through no fault of your own, if that makes sense. So I want to make sure that my income is never completely disrupted. And my best way of doing that is by making sure I don't rely on any one particular income source. Then we have to move on to protecting those assets, because the banks aren't safe. We know that. Someone actually made a comment on the live stream yesterday morning and mentioned that the banks are no longer FDIC insured. And I actually asked, I said, hey, if you have any documented proof of this, please share it with me. And shortly after the live stream, I received an email with a great link to a YouTube video that explained the banking systems and the fall of Cyprus, and, how much money is out there and how much debt exists and this, that, and the other. And basically the banks are gambling with our money. And you sign over your money to the banks. Theoretically, it's not yours anymore once you put it in the bank. Theoretically, it's not yours anymore once you put it in the bank. And then they proceed to gamble with your money, plain and simple. However, here's the kicker. The money is still FDIC insured. It is. But you got to think about it like having homeowners insurance or car insurance. Imagine if you had car insurance. And this is something that a lot of people don't know. With the price of vehicles going up today, with the price of living expenses going up today, with the price of everything going up today, there's that word inflation again. Old insurance policies may not have enough coverage for the damages that you may receive in an accident. So if you have a $50,000 bodily harm, bodily injury, insurance coverage, today, if you go and you have an accident and the bill could easily be $200,000. So we wouldn't necessarily say in that situation that you don't have insurance. It's just that the insurance that you have isn't enough coverage for the claim, for the repairs of the damage, to cover you, to make you whole. And that's similar to housing, where with the rising cost of homes and building materials and replacement costs, here's the thing, we saw an increase in insurance premiums going up because of these reasons. However, we did not see insurance companies adjusting policies to cover these differences. So if you had a homeowner's insurance policy that, you bought a house for $300,000, cash, finance, whatever it may be, its appraised value is $300,000, and you have a homeowner's insurance policy that covers $300,000, and through the rapid increase in home prices and home values and appreciation during the pandemic, that $300,000 home is now worth $550,000. Who knows what the number may be? And perhaps maybe this home was in an area that was prone to hurricanes or storm damage, and there was a tremendous amount of damage done to this home that basically just blew it away, just destroyed the home. Well, that insurance policy is only good for $300,000. So guess how much they're going to give you? Now, you may say, well, I only had a mortgage for $300,000. So, it pays off my mortgage. Great. But you've missed out on the equity opportunity, and your replacement cost is going to be much higher than $300,000 because it's now a $550,000 market. You did have insurance, but you were underinsured. And perhaps maybe even you refinanced, but you didn't adjust your insurance coverage, and now you have a $200,000 to $250,000 deficit that you have to make up because your insurance won't cover the difference. But it would be unfair to say that you didn't have insurance, because you did. And that's similar to what FDIC is. FDIC insures bank accounts to a certain amount per depositor, but the kicker is that FDIC doesn't have enough money in cash reserves to actually pay for all the accounts that they insure. So I think it would be unfair to say that FDIC no longer insures accounts, but it is fair to say that they don't have enough to cover it, which is pretty much a lot of different insurance companies in their situation and positions that they are in today, and they have been for very long periods of time. But this is where the gamble comes in, because the insurance companies would typically take your policy premium payments and gamble them much like the banks would. Now, they wouldn't go out to Vegas or Atlantic City or Biloxi and put it on, and start playing roulette or craps or blackjack. But they would take that money and they would invest it in the markets to gain interest and receive a return on their investments to help bolster their portfolios to have the net worth and theoretical assets to cover the claims, assuming they only had a percentage of loss, not 100%. They'd have to have a smaller percentage of loss, because the fact of the matter is that if any insurance company were to realize 100% loss through all their policies, nobody has enough money. All they have is a gamble and time. So, basically the gamble is, as an insurance company, we're looking to net $1 million profit every year by way of, receiving returns on our investments from these policy premiums that have been paid, minus the losses that should net 1 million. Every year we gain another million. Every year we compound that interest to then reinvest to increase our worth. And hopefully with time, we can continue to make the money and continue to see less loss than gains. But the problem with that is today is that the the markets aren't returning the same profits and growth and gain as they were in the past. So now the insurance companies are looking at it, well, we're still incurring the loss. We're just not making the gains. And the losses seem to be increasing in quantity, in percentage, and in frequency, as well as in value, because everything costs more. There's that word inflation again. So they are on a downward spiral, which is going to have a huge impact for insurance policies and insurance carriers and the theoretically insured folks out there that think that they are covered. Which is yet another reason why you're going to want to make sure you have a backup reserve, assets, safety net, just in case. You need to cover yourself first and then work to be reimbursed. Otherwise, you're going to be sit there high and dry, waiting for someone to tell you, to tell you that eventually, ultimately, they're going to be waiting for someone to tell you that they don't have the money. Sorry, our deepest condolences, but we don't have the money to help you, to support you, to fix whatever problem was there, make any repairs or whatever it may be. So I want to personally make sure I continuously have ways of producing income that aren't directly tied to one particular source, one single point of failure, i.e. a job that I could lose, be laid off from, have my hours cut and reduced, which plenty of comments and emails coming through of folks saying that they've had their hours reduced as these companies are just trying to cut back. The employees are the most expensive operating costs, overhead expense for businesses. With a weak Black Friday, I think the headlines called it thin crowds. We are seeing 2022 shake out to be a rough year. 2023, financially, economically, for businesses it's going to be a struggle. But it doesn't mean that we can't push through it. So, with that being said, there are ways out there to maintain your income. There are ways out there to increase your income, to continuously have checks coming inbound, direct deposits coming inbound that you can then facilitate and put out into the world to further produce more returns on your investments. And part of that safety that I was telling you guys about is protecting this money, protecting these assets, protecting that growth potential. And the banks aren't safe. So what do you do? Well, in my opinion, I prefer cash flow producing assets. And the reason why I prefer cash flow producing assets is because a bank, even if the bank says it's a high yield bank account, high yield savings, high interest savings, it's nothing in comparison to inflation. It's nothing. And once you put the money in the bank, it's no longer technically yours. While also the FDIC doesn't have enough money to actually back it in the event of a huge catastrophic emergency. And if you really want to see enough of a return, you'd have to put in a substantial amount of money in the bank to see that, which would immediately negate the safety of FDIC or the perceived safety of FDIC, because we're talking about a few $1 million in the bank to actually see some form of, decent return, considering the low interest rates that you would receive on your deposits. So I don't want to unnecessarily put my wealth at risk to receive a minor return. So instead, cash flow producing assets where I can take the money, put it into assets that have multiple layers of protection that don't just stay safe. They bring back more money. Why? Well, because if I were to lose my job, guess what? I'll still have money coming in from these assets that produce cash flow. So, for example, real estate, homes. I would buy a home. I would buy a piece of property that is cash flow producing. And it would be a business expense and a depreciating asset that would offset my revenues and ultimately reduce my net income. But that would be a topic for another video discussion. But a home, I would own the property. I would have it insured. Obviously, we know that insurance isn't the end all be all, but I'm going to have every single layer of protection that I can possibly have. We'll have to settle up on that later. I'm not going to unnecessarily put myself at risk by not having it. Speaking of which, I would have home warranties on all these properties. Link in the description. Free quote. Just go get your free quote for your home warranty, because as a cash flow producing asset, I'm going to have a tenant. I'm going to have several tenants possibly in these properties. However, the properties are my responsibility, and I don't want to be unnecessarily paying higher costs for repairs. So I'll just get a home warranty. I'll cover these major appliances and these big ticket purchases and repairs on warranty. So there's a link in the description. Go get your free home warranty quote. Now, I would own the home, I would own the property, I'd own the land, and I would then make the property, the home, the house, the townhome, the condo, whatever it may be, produce cash flow, so that it not only covers all of my expenses, but it produces a profit every single month. So I have a new form of income. I have a new stream of income, a relatively passive stream of income. And I would do this as often as possible. I would continuously build up my portfolio with more assets that produce cash flow, so that my money is better protected and performing at a higher level than it would at a bank. I would always have cash, multiple sources of cash, although that cash would be losing in its purchasing ability every single day since it's not earning a return because of inflation. I'm okay with that because I would always have the safety, comfort, and peace of mind that I don't need a bank. I don't have to worry about a bank or several banks shutting down when the bank runs occur and I can't get cash to buy food, to pay expenses, to survive on a daily basis. I'm okay with that because I'm okay with knowing I have it versus fearing losing it or not having access to it. We can talk about that in another video. And then I would have other investments, other businesses. I'd have as many as I possibly could, which I'll go into. If you guys want to know more about that, drop a comment down below. If I get enough interest in the comment section, I'll make sure to make that video. And I would just be I would further add layers of protection to my income and my savings and my investments portfolio so that I'm never at a single point of failure. So that down the road, as you know, time goes on and I get up there in age and I decide, hey, now's the time. I'm ready to retire. I'm not just relying on my retirement savings. I'm not just relying on the returns from my retirement investments. No, I've got seemingly the trifecta. I'll have the savings, I'll have the investments that are bringing returns, and I'll also have the assets that are cash flow producing assets that continuously pay me so that my retirement isn't based on chipping away at my savings. My retirement is actually still a period of time where my net worth, my investment, my total portfolio is still growing, not being eaten away until, it's time for me to go home. So that would be my plan so that I don't find myself in a situation where I say, I've worked all this time only to lose everything. Nah. My portfolio is based on strong cash flow producing assets, equity shares in strong, viable businesses, extremely low overhead businesses, folks. Low overhead businesses are almost recession proof because a low overhead business doesn't have to cut costs or theoretically close and shut down because there's no cost. There's literally only upside, pretty much only upside. And YouTube, I've mentioned before, folks, make content. Content is important. Content is valuable. But YouTube, for some, literally has no cost besides the time it takes you physically, as I'm sitting here talking to you folks for about 30 minutes, and the cost of perhaps maybe internet access, which you were going to have anyway. Now, granted, there are some channels out there that spend thousands, hundreds of thousands, millions of dollars making videos to gain, hopefully, greater returns than the investments that they put into making this content. But for many, it can be done at literally no cost, where you say, well, the economy is not doing too well for advertising, or it's not doing too well for YouTubers or whatever. That's fine. I don't have to shut down my business because it doesn't cost me anything to run it. You see what I'm saying? And then when things turn around, when that cycle revolves, when we get out of that dip and start climbing back up, much like we're going to see across all sectors of the markets, we're going to see that happen. It's cyclical. This is nothing new. History repeats itself. Then just do it again. Wherever, with having multiple sources and diverse strategies for producing income, I'm going to position myself to maximize on the growth and income return opportunities for the ones that are producing the most at that time, you know, um, versus being locked in and stuck in one particular situation, one particular job, one particular income source that is ultimately out of my control 100%, and leaving me and myself and my family vulnerable to the economy, the Fed, president, inflation, a recession, war, utility companies and raised energy costs, anything, you name it. I can't control them all, but I can definitely work towards controlling how much of an impact they would have on me and my family and my ability to survive financially by continuously working to produce income from cash flow producing assets and protecting them in the process, and evolving and adapting to the new changes that will occur each and every day to protect that wealth. If you guys want to know more about that, let me know. Drop a comment. Hit me up on my email. It's in the description. I will not contact you in the comments below. If you see a WhatsApp number, do not engage with it. It is not me. I hope you guys take care. Be safe. I wish you well, and I will see you on the next one. See ya.